software stocks just lost up to 80% of their value. And almost nobody is talking about what's happening now. I'm Alex Carter. Welcome back to Wealth Signal. Quick note before we dive in, this video is for education only, not financial advice. Always do your own research before you invest a single dollar. Late last year, a theory took over Silicon Valley. People called it the SaaS apocalypse, the idea that AI would let any company replace its software overnight for free. Investors panicked. Some of the best software businesses on the planet got cut in half, or worse, in a matter of months. Whitney Tilson at Stansberry Research has been tracking this sell-off closely, and he says the theory doesn't hold up in the numbers. Today we're breaking down 3 software stocks that got hammered by this panic, and why the fundamentals tell a completely different story. If you want more breakdowns like this before the crowd catches on, hit subscribe now. It genuinely helps this channel grow. First up, ServiceNow, ticker NOW. This is a $122 billion company that runs the internal operations of some of the biggest corporations on Earth. And the market just treated it like it was going out of business. The stock fell from almost $200 to $80. That's a drop of over 50%. But here's the thing. When a stock falls that hard, you usually see it in the numbers. Losses, slowing growth, customers leaving. With ServiceNow, none of that showed up. Margins stayed stable. Growth kept going. Free cash flow kept gushing. The bear case was built entirely on a fear about the future, not on anything actually happening inside the business right now. That gap, between the story and the numbers, is exactly where opportunity tends to hide. Here's the number that stands out. ServiceNow historically traded around 60 times forward earnings. At the bottom, it was trading closer to 26. Even after bouncing back roughly 30% from its low, it's still down 40 to 50% from its all-time high. Before we move on, everything I've referenced visually in this video is saved as a downloadable summary file in our Wealth Signal Telegram channel, along with every past and future videos file. Links in the description. Go grab it. Second name, Veeva Systems, ticker VEEV. You've probably never heard of it. That's the point. It's the software that basically every major pharmaceutical company uses to run their clinical trials. 19 years after it was founded, Veeva is still run by the same founder, and it has something close to a monopoly. The top 20 biotech and pharma companies in the world nearly all use this platform, which means regulators are used to seeing data in exactly this format. That's a moat AI can't easily cross. This is one of the most heavily regulated industries on the planet. You can't just swap out your clinical trial software for a chatbot. Veeva sits on about $8 billion in cash, with zero debt. The stock historically traded around 60 times forward earnings. At the low, it dipped to 16 times. It's since recovered to about 22 times, still a long way from where a business this dominant has traded in the past. Third, and this one's personal, because I use their tools constantly. Adobe, ticker ADBE. It's the most beaten-down name on this list, and honestly, it has the most legitimate reason to be. Adobe faces real AI competition in content creation, and the market has priced that in hard. The stock peaked near $700 a few years back, fell under $200, and now sits around $250. That's the steepest fall of the 3. But even with that real risk on the table, Adobe just reported 12% revenue growth, in line with its own history. That's not the number you'd expect from a company people think is being replaced. Adobe is trading at just under 10 times forward earnings, versus a historical range in the 30s and 40s. If the growth simply holds and the multiple normalizes back toward 20, That's a business that could double from here without needing a miracle. This isn't the first time a real technology shift got mistaken for a mass extinction event. Back during the dot-com crash, some of the biggest names in networking and telecom fell 80 to 100% and never came back. But traditional retailers people had written off, like Home Depot and Costco, went on to become some of the best-performing stocks of the next 25 years. Even Amazon dropped over 90% in that crash. The lesson isn't that every beaten-down stock recovers. Plenty didn't. The lesson is that panic and fundamentals are two different things, and the gap between them is where the real research pays off. So here's my take. 3 software companies the market priced for collapse, all still generating real cash, real growth, and real moats. If you found this useful, hit like, drop a comment telling me which of these 3 you'd want a deeper breakdown on, and subscribe so you don't miss what we cover next. And if you want the visual summary file for this video, join the Wealth Signal Telegram channel. Link is in the description. I'm Alex Carter, and I'll see you in the next one.